Sitting here today with Michael Furey. So Michael is part of our investment committee. We met Michael about a year ago, and Hudson have been working with Michael now for a year. He's heads up our investment committee along with myself, Ivan Fletcher, Isaac Robinson and Melissa Grimshaw. And I wanted to get Michael here today because about a month ago now we launched our managed accounts, and it's a huge milestone for Hudson. It's exciting, it's something we wanted to do for a long time. And I'm very proud to be associated with Michael. Michael is, actually I'll let Michael tell you a little bit about himself, but he heads up Delta Research and Advisory, and he's a huge asset for Hudson. And Michael's here today to tell you all about managed accounts and why we use them, the benefits of them, and why we love them. And then I'm going to pick his brain for a couple of quick questions at the end of it. So Michael, tell us about, well, first of all, tell everyone about yourself, because I know a lot about you, but our clients won't necessarily.
Okay, well, as you mentioned, my business is called Delta Research and Advisory, and the business does do research. It's primarily quantitative. I'm a mathematician by background, so yeah, hello ladies. And the advisory part is really the bulk of Delta's business, where it's all about portfolio design, from governance to asset allocation to manager selection, and then the overall, just putting it all together.
Which is very important, because with the managed accounts, the idea of managed accounts is that a client who comes to us, we talk to the client, we work out their risk profile. It's all very much about risk profiles. Let's say they're an aggressive investor, and after discussions with their advisor, they're an aggressive investor. We would choose to put them into the high growth managed account. And with the managed account, the beauty of the managed account is that every quarter we sit down as an investment committee, talk about the markets, and we can tweak these managed accounts without ever having to speak to the client again. So it can happen very instantaneously. Can you explain a little bit how that works?
Yeah, so as you mentioned, the managed accounts run via an investment committee. So we're making decisions around where we perceive markets and the economy. That feeds into our asset allocation. It'll also feed into the types of investments that we have within the various asset classes. So the beauty of managed accounts, well, they're essentially like any portfolio, but when we make a transaction, it happens across all investors at the same time. So all investors are treated equally, as opposed to, I guess, sometimes different timings with coming in for meetings with advisors.
Of course, and sometimes when big events hit like COVID, it's hard to get through. We've got 3,000 clients, 1,000 active clients that are involved in shares or funds with us. You can't get through 1,000 clients in 1 week to let them know things are happening, or to change, to ask them if it's okay to change their portfolio around. And without a managed account, you would have to give us authority, to change some of those funds around. Whereas within a managed account, within specified guidelines, we're able to move things around without having to contact 1,000 clients at once. It can all happen within 24 hours. So it does have a lot of risk mitigation running a managed account. And it just means that, like you said, if you've got 5,000 or 500,000, you're all treated exactly the same. So there's a lot of benefits to having a managed account. And having Michael step in on the investment committee means we get the benefit of his research, his software, his brain, and then we all sit together and talk about the economy. We even talk about societal trends, geopolitical threats. There's a lot of world elections happening this year. So a lot of, and it's really every quarter. I mean, we talk every month, but we make changes if we need to on a quarterly basis.
Exactly right.
To the accounts.
Yeah, so we position the portfolios across, I guess, 3 main components as well. So we have a core satellite approach, which has always been the Hudson way. The core's index.
Yes.
Nice, low cost way of accessing asset class returns. Asset allocation is our primary driver, which is the first core part. And the satellites are strategies which we perceive will outperform. And so that comes into the other 2 components, where we'll go actively managed, and we might take on a particular position on style, like we might buy cheap stocks, or maybe we'll be buying shorter term to maturity bonds like term deposits. And then we might take positions around particular active managers that we perceive will outperform.
So at the moment, with the markets being quite high, when we're sitting in these investment committees, obviously we've got to mitigate some of this risk, because what comes up usually comes down.
Exactly right, yes.
Everything's high though. Property's high, shares are high.
Yep.
Fixed interest is quite high. Well, high for the last 5 or 6 years anyway.
Yes.
So everything's high right now. How do you approach that when you're talking to the investment community? How do we all approach that?
Well, first of all, we have some basic investment principles that guide us with the decision. So I mentioned asset allocation is the driver of return. So and then a second principle is diversification. So we're always diversified across asset classes, and if we're worried about how expensive markets are, then we're still going to access markets, but we'll underweight those particular markets. So an example at the moment is certainly the US share market is in the most, it's only 10% of the time you could argue it's been more expensive. So it's up there at the moment. So we're a little bit underweight US at the moment. We're not out of the US.
No.
That would go against their principles.
Yeah.
But we do have an underweight position.
Yes. I think anyone who's investing in equities has to understand that capital that you have at any stage in equities could be less than what you put in. That's right. Yeah. Unless you're very defensive and you've gone for fixed interest and bonds and you've gone extremely defensive, equities are always going to be a lot more volatile. When the markets are this high, I think it's really important to pre-position that with clients because it's going to be an interesting year, I think, interest rates and events. And
I think one of the themes that we're talking about and we're prepared for with the portfolios is greater volatility.
I agree.
And so we do have an allocation to some strategies that will hopefully mitigate that volatility as well.
One thing I loved actually we spoke about in the last committee meeting was you were talking about some of the fund managers we're using, and some of them are actually sitting on a fair bit of cash waiting for opportunities. So although they might be in equities, a lot of their portfolio is sitting in cash, waiting to take on some of these opportunities. That's what I love about having you part of our investment committee. We don't have time to research these funds. Our business is talking to clients and relationships with clients. So having you come in to talk about some of these funds that have access to cash and who are investing into some thematic areas as well. I mean, outside of the managed accounts, I've got a really special interest because I'm a super aggressive, Michael. Anyone here would say I'm a super aggressive investor. I would leverage as much as the banks will give me. I will leverage. I will go into the most aggressive fund you can imagine. So they've got to rein me back here. But we have put together, with the help of Michael reining me back, an enhanced growth fund, and it can't be a managed account because it is too aggressive. But it has thematic themes in it. Like it's got. In fact, I need to talk to you about a Bitcoin, a crypto fund to be part of it. So
all right.
So last year it had. So we started this in May last year, and it's had some fantastic. The Uranium ETF has done exceptionally well. We've had some really aggressive funds in there. Overall, the fund has performed around 19% for 12 months. Okay. So, but some of the funds in there did 60%. Others have done minus 2%. But overall, it's a super aggressive fund. But it invests into a lot of these areas, and it's obviously not for anyone who's at all got any sort of worry.
Yeah, so if I can elaborate on that fund, it is compared to our managed accounts, it's at the riskier end. We've got concentrated positions there where we're trying to capture, as you suggest, themes that we think will work in the long term.
Societal themes,
Environmental themes are in there, or general ESG, sort of environmental, social, governance. We perceive that there are markets that seem to be significantly cheaper than others, so we've got exposures there. And then there's the technology side of things as well, where there's a lot of momentum there, so we're capturing that momentum. And then finally, we were looking at some of the more less liquid but higher yielding investments as well. So we had a small sleeve there. So we're trying to, over 12 months to get 19, nearly 20% is a great result. That will be volatile, but certainly the aim is to get a high return for that higher. At different times,
it can be higher as well. There's actually another ETF. This is what I do with Michael all the time. There's another ETF that I want to talk to him about, which we won't do in front of the camera today, but it's Global Cybersecurity ETF. So
yeah.
150 companies across the globe, including Australia.
I think you'll find that was on my consideration list for
Was it?
for the
We
high
need to
growth.
talk.
Yeah. Because cybersecurity, obviously, a massive theme.
Huge.
I think the issues or risks around cybersecurity are only going to get worse.
Me too.
So those companies that are specialising in that, they certainly have great growth opportunities. So,
and we don't always. Some of these small thematics, these themes may be in the high growth managed accounts. But again, the managed accounts mitigate a lot of risk as well. They're meant to outperform, but they're also meant to give you some safety, some comfort. The high growth one is meant to we're aiming for, at the moment, I think it's been returning quite well, the high growth one.
Yeah, definitely.
But the markets have been quite high. But we are always looking for innovative funds. They don't always fall into the managed accounts, but with the managed account, you could have 75% of your money into a managed account, and you could put 25% of your money, depending on your risk profile. I've got to keep saying that, the disclaimer of the whole risk profile.
We have 7 managed accounts with 7 different risk profiles.
And if you're right off the chart, we even have that. We even have that model over here.
Yeah.
But again, it's off the chart. One question about managed funds, though, it's something that people worry about losing their money at the moment. If I go into the markets, share markets are high. I think that happens you got more risk of that happening with stocks. I don't know if my facts are right here, but I think something like 75 or 85% of the companies that listed 40 years ago on the S&P 500 are no longer listed. Like particular companies.
That would not surprise me.
So particular companies, but with a managed fund, there's generally around 200 stocks or 100 stocks at least in each fund.
Yeah,
would I be right
absolutely.
in saying that? And so if one stock does, delist or something happens to it, the fund manager is there to protect you from those sorts of things.
Yeah, correct. So we've got funds with maybe as little as 30, 40 securities, and then funds with hundreds of securities that underlie. Yeah. So that goes to the principle of diversification. So
you're not really going to lose your money with a fund. You hold on to
that
fund.
No, it's virtually impossible to lose. Well, it is impossible to lose all of your money, and that's why I say we're capturing the market, and the average return of stocks, to be honest, is typically less than the market. So we're capturing the market and then aiming to use the skill of managers to get above that. That's part of the risk management of our portfolio.
Agreed, yeah.
And then we diversify not just across markets or securities, we're diversifying across styles. And you mentioned how expensive markets are at the moment. So we've taken a position on a style basis where we do have a little, our average valuations are actually cheaper than the market.
Yeah.
So we're sort of providing a bit of mitigation to that expensive risk as well.
Yeah. One more question while I've got you, and then I'll let you go. We've still got a lot of clients who've got, say, 8 or 9 shares.
Yep.
Along with some managed accounts in small companies and emerging markets, and they use these shares in retirement to get the franking credits, because they then get the refund as well. So they get the dividend, and it's fully franked, and then they get a refund once they're in pension phase.
Yep.
As with the managed accounts, because we do a lot of our retirement plans now through these managed accounts, because there is so much more risk mitigation with managed accounts. I love them for retirement. How do we factor in these dividends? If someone just did managed accounts with us, are we able to? I can't quite work it out what I'm trying to ask you, but are we able to replicate? There we go, replicate. Are we able to replicate? Is there a fully franked dividend yielding fund that we put into any of our managed accounts in retirement?
Yeah, we do have. There are 1 or 2 funds that do have what we call a value style, and when we talk about value, it certainly means cheaper, but that normally comes with a higher dividend yield as well. Yep. So the companies that pay higher dividend yields and have that more consistent income with fully franked dividends, they tend to be the more boring stocks.
Yeah.
Okay. The growth
stocks,
exactly.
Yeah.
The stocks that are less volatile, whereas those growth-oriented, say, technology stocks, particularly in the USA as an example, they do not have strong dividend yields at all. So of the big companies of the world, Microsoft is one of the biggest dividend payers, it only pays 0.5% dividend.
Yeah, right.
That is, whereas the Australian stock market's paying 4% plus franking.
Yeah, that's right.
And so we certainly have some funds that are capturing some of that.
Yeah, because it's good. It definitely comes up a lot, and I think it's especially with some of the baby boomers, you know, who've had their shares forever, and shares, you know, franking credits have got a fantastic place in the retirement portfolios. So I think that's. I just really wanted to get you here today to talk, so everyone could sort of see us talk, to see what we talk about, to see how it works, to see that we are really trying to look after our clients. Managed funds are an excellent way of being able to capture changes, trends, and we can do this on bulk. And it's wonderful having Michael, and I'm really very grateful for you coming in today. You're very busy.
My pleasure.
You're always around, and I really thank you.
No, pleasure.
And